Joining us this morning with his outlook on the space, BofA's Julien Dumoulin-Smith. Julien, it's great to have you. Worst performing sector of the year. Is it too early to start looking for value?
Look, I'm not going to step in here. Again, you've seen a little bit of a crisis of confidence with NextEra here in the recent days. And my point to you guys would be, look, this is the figurative canary, if you will, in the coal mine for the space. Look, they're just the first of a slew of different companies that are going to be out there talking about their guidance updates here. Third quarter, fourth quarter are going to be a challenging time. I'm frankly not all that surprised, given the setup here, that you're not seeing that much of a bid for the sector heading into a slew of further recoveries in just the weeks ahead, right? NextEra is the starting point here. And really, again, as you guys said a moment ago, with a 4.8 10-year, 4.3 div yield, look, this is not the space that retail is looking for. It's been 15 years since we've seen the setup. Look, I think there's a better place.
What happened with NextEra?
Look, I think the NextEra setup is really about, it's a story of interest rates, right? This is a story of confidence. It's the first time in a decade that this company has seen this kind of question, right? It had been at a super premium versus the sector. There had been really fairly limited questions about its abilities to deliver consistent earnings growth. And really, the interest rate question has caused some gyrations, right? So for as much as NextEra has some offsets and some other considerations, right, the real question is, what happens next across the space?
And they took down earnings forecasts, right? They warned on long-term growth.
Well, actually, that's what's really interesting about this. If you've seen the gyrations, and again, they were trading at a pretty super premium to the rest of the group. They didn't even touch their guidance, right? And I'm not even calling for them to bring down their long-term guidance here. That's actually somewhat intact. We were thinking earlier that they were going to exceed their guidance ranges. They've had a history of delivering on that front. This is just about bringing it back in line with their historical ranges, right? And bringing it back in line with historical earnings growth across the rest of the group. That's all we've seen thus far. We've seen a sharp gyration in NextEra. The question is, as you see other companies which don't have the benefit of interest rate swaps, which have more material equity raises to come, again, that's why I'm using this phrase, is this the canary?
You go to 53, which I think is a street low. You want to talk about how you got to that number?
Yeah, look, I mean, we're the street low. I'm going to be open about that. And obviously the sector's been trading off, which certainly contributes to that. But in this environment, you've seen a lot of their peers trade off, and this somewhat becomes circular. What are folks willing to pay for renewable energy companies in this environment? Certainly has been under a lot of duress across the space. And let me be very clear about this, right? I mean, the entire space has actually somewhat outperformed a correlation versus rates. The latest step down in the whole space is really just a correlation to get back in alignment with the move higher in rates that you guys were just talking about.
Pretty fascinating picture. Obviously, you can sort of understand the broad backdrop, but the valuation, obviously, Street's still wrestling with. Julien, thank you. Julien Dumoulin-Smith over at BofA. Thanks.